Here's the economic update for the end of August 2025. I'm going to start with the leading economic indicators. Effectively, 21st of August, we got this. It's the fourth month that the LEI is now flashing a recession warning. The current economic indicators are, at least what it looks like, starting to peak. Once these go down, you're in a recession. The leading economic indicators can go down for a period of time before you're actually in a recession. Now, the Conference Board, basically, they're saying that they don't expect a recession, but they do expect the second half of 2025 to be an economic slowdown. A couple of things that are causing this: basically, there's a lack of housing permits, there's a lack of new orders for manufactured goods, and consumer expectations, basically over the next 12 months, they're not looking good at the moment. The other thing we're finding is August 29th, there was a report put out. Basically, the 90-day plus delinquencies are up across all credit tiers. And these are primarily in homes and auto loans. Now, you'll see that it's like, okay, even the highest credit ratings, those people have more than 100% increase in delinquencies. But remember, when you have a very small number and it's just a small increase, that could be hundreds of percent increase because you have a very small number and another very small number. So to me, it's not as bad as what people make it out to be, but it is an early indication that something's going wrong across all credit scores, across basically anybody that's taking loans out. So I would say overall, it's like a 10-20% increase if you look at the chart. It's not hundreds of percent increase across all tiers. If you look at the housing situation, August 21st, we're looking at about 4.6 months of inventory. Just be aware that less than 6 months is a seller's market, and 6 months is an equal market of buyers and sellers. And then anything more than 6 months worth of inventory, that's really a buyer's market. This shift from seller market to buyer's market is starting to occur in some markets, but not all areas equally distributed across the United States. So you'll see like an increase of 0.8% of existing home sales, or plus 0.2% in median home price year over year for those existing homes. Now, this is 422,000 for existing homes. We're finding that new homes are actually selling for a lot less, so 404,000 for a new home. Now, why could that be? Well, some of the new construction homes are actually smaller in square footage. Also, they're trying to offload inventory. While we have 4.6 months of inventory of homes for existing homes, it's actually much more inventory for new homes. When you have a lot of inventory of the new homes, you want to try to move that along because those businesses need to sell them, get them off the books. So if you are trying to move them, you drop your price, you have concessions, things like that. And then if you have a lot of inventory, you're also not going to apply for new building permits, because why do you want to build more homes if you can't sell the ones that you already built? So that's leading to the housing permits not being pulled. Northeast is doing really well in terms of increasing in price and the number of homes that are selling. Midwest is also having increases in price, just not as much as the Northeast. However, the South and the West, they're looking at declining prices. So with this, I put arrows up and down in green and red, but depending if you're a buyer or seller, it could swap, back and forth. If you're looking to buy a house, you want prices to go down. If you're looking to sell a house, you want prices to go up. When we look at our gross domestic product, first quarter, basically GDP was negative by 0.5%. At the end of August, our second quarter revision for GDP, we're at plus 3.3%, so that went up by about 0.3%. So positive is good that you're growing, and this is real GDP, so this is with taking into account inflation. So we're growing ahead of inflation. If you grow your economy in a country faster than basically your debt, you can make the debt to income level of the country go down. So that's a benefit so that you can pay down either national debt or not allow it to climb out of control. August 29th, we also got the GDP Now forecast for third quarter. It looks like plus 3.5%. I know this was hovering around about 1.5% to 2% over the last couple of months, but that's gone up as well. Mid-August, we have the U.S. retail sales. This was at $726 billion. That was up 0.5%. But again, when you have an error of plus or minus 0.4, that could be as low as 0.1% or 0.9% month over month. Year over year, it was positive 3.9%. August 29th, our personal income was up 112 billion or plus 0.4%. Disposable personal income up 93.9 billion or up 0.4%. Consumer spending was up 108.9 billion. The increase in spending mostly is coming from what looks to be automotive, like cars, car parts, insurance, financial services, those types of things. Consumer expectations, this came in August 26th. We're at 74.8. Anything below 80 is another recession warning. August 15th, consumer sentiment, we were down 13.7% year over year. Current economic conditions down 0.7% year over year. Expectations for the future down 20.7%. So those expectations, I'm going back down for LEI. For our inflation numbers, August 29th, our personal consumption expenditures were 2.6%, and our PCE core, so this is taking away, food, energy, gas, those types of things. This was 2.9%. It's not changed that dramatically from the last one. It was the same 2.6% on last month. It was 2.8% the prior month. August 12th, our consumer price index, 2.7%, core 3.1%. On August 14th, we had our last producers pricing index, and basically that's 3.3% and 2.8%. Generally what happens is you see an increase in the price that the people that are producing your goods are paying, and then they eventually have to pass that cost on to the consumers, and then you'll see that in the CPI and the PCE later. We want a 2% inflation rate. You don't want it to be much hotter because then you won't have stable prices, and stable prices are part of the dual mandate. The other one is maximum employment. I know in 2020 we had a flexible average. In 2025, that's gone away because we've been running hot for too long. We don't yet have the new jobs report, which will be early September. We've had revisions at the beginning of August. Basically, May was revised down to 19,000 instead of 144,000. June was revised down to 14,000, not 147,000. So this is off by an order of magnitude. So effectively, we had a loss of over 250,000 jobs, and that also resulted in Trump firing the BLS person in charge there. Our unemployment rate's still at 4.2%. We've been at 4 to 4.2% since May of 2024. In July, we've added 73,000 jobs. Basically, that's low. It was expected to be about 110,000. You need about 80,000 to maintain the same unemployment rate because you have about 80,000 people that want to join the workforce monthly. When we looked at the CEO survey, 34% of CEOs are looking to reduce their workforce over the next 12 months, and about 27% of CEOs plan to increase the workforce over the next 12 months. I'm seeing a lot of companies at the moment basically reduce the amount of hiring they have. They're allowing people to just leave but not backfill positions. I had a friend this past week just lose his job due to a layoff. I have another friend that works at Microsoft, and effectively they've laid off another 9,000 people, and people are just getting a bit concerned because they don't know if they're going to have a job. And finding a job is becoming very difficult. So a lot of places, if they're not hiring, if you lose your job, it may take a while to actually find something. At the end of July, It's the most recent JOLTS report. There was about 7.4 million open jobs and about 7.2 million people that were unemployed. It's very close of 1-to-1. This is still going down, not in the direction you necessarily want if you're looking for a job. You always may have a mismatch of skills or location and the job that's open versus what you're looking to do for work. Once people go on unemployment, we're finding that, they're unemployed for 6+ months, and that makes up about a quarter of all the people that are on unemployment. So it's really important to have an emergency fund for this type of situation. We had the latest FOMC meeting on 30th of July. There was no rate cut for our interest rates. The prediction would be we're probably going to see about a 0.25% interest rate cut for the Fed fund rate when they next meet on September 17th. So with all of this, what am I doing right now? Well, like I said, people that lose their jobs, they're staying on unemployment and are unable to find a job for about 6+ months at the moment. Try to get an emergency fund together now if you're still working and build that up, but realize that we all have to start somewhere. So if you don't have a month saved up, try to get 2 months, try to get 3 months, try to build that amount up. Any money that I need in, let's say, the next 5 years, that would include emergency funds. I'm going to put that in CDs, high yield savings, maybe some bonds. And for any money that's not needed for at least 5 or more years, those are what I'm going to use for dollar cost averaging into primarily the S&P 500, about 75% right now. International fund, maybe about 12% right now in my account. And the remaining is going to be between bonds, CDs, high yield savings. So that's where I'm investing my money at the moment. So that's really what I would consider investing. The rest of this is speculation. It's a bit more of gambling, I would say. Prior performance does not guarantee future performance. Anything that's invested can lose value. With a very small percentage of my portfolio, I bought some insurance, the SPY puts at a $500 strike price. This is at the end of September, and I bought it for $1.49 a share, so it's not that expensive to me. So this effectively protects about $50,000 worth of loss for each one of these that I bought. I still have some UVXY. I bought it at less than $20 a share. I have a trailing stop of 20. This really goes up when people are fearful, when the VIX goes up. So I was expecting, which did not occur, that tariffs would have gone into effect earlier this month, but then that's been delayed at least for China until November 10th. So that's probably not going to change that much. I have call options on TLT. These are 20-year bonds. Basically, I'm looking for January 2027 with a strike price of about 110. I believe that the Fed will drop its interest rates over the next year to 2 years, and the reason for that is because we'll hit an economic slowdown or recession. So if that happens, bonds move the opposite direction of interest. So as interest rates go down, bond values go up. And if interest rates go up, bond values go down. So that's why I'm taking that position at the moment. All right, well, thank you for watching. Please subscribe. I put a lot of content out where I discuss economic updates, also how to make more money, how to save, how to invest, taxes, how to be an entrepreneur, start businesses, that sort of thing. I do have a free Discord channel. You're welcome to join that. Understand that there's scammers that will try to direct message people. I can't really do anything about that, but I'm not going to direct message you unless I'm actually talking to you. So if you notice, I also opened up memberships on the channel. So if you're a member, basically you get to see the content before everybody else does. And then after it goes through all of its checks, I still put it out for the rest of the group. But if you're looking to get the content a bit earlier, so you may have noticed on a couple of the videos, as I put videos out, before it goes through all of its checks, I allow members to watch it. So if you've noticed, I turned memberships on to the channel so that if you want to see the content as Google's still doing its review, you can have access to that. And then once it's all done, then it goes out to the rest of the group. Also, memberships help to support me in the work that I'm doing. Well, Thank you for watching. Please subscribe and have a great day.